Guten Morgen, was hast du verpasst? Ja, Zinsentscheidung bis jetzt, Dotplots, also die Erwartung der Notenmitglieder, 25 Basispunkte, Zinserhöhung.
Okay. Hello, hello, hello. It would be wonderful if you could tell me if you can see me and hear me well. And then I would say, let's get started. Oh, it will be a wonderful 30 minutes with you guys. And yeah, in 15 minutes, the FOMC press conference is starting. And then we will see what's going on. What is Jerome saying? Is he giving some hope into the market, or is he like, nope, we gonna increase the Fed and the interest rates? We gonna see what he's going to do. But maybe you already saw it. We got the 25 basis point change. As I said, for me it was like absolutely clear that he's gonna do that, because obviously if he wouldn't do that, then it would be a too big and too positive sign for the market. And yeah, I don't think that that was not too not what he wants to do. And that's why I as well think that he's gonna be really negative in his talk. Um so as well we got the, let's check, we got the dot plot as well. Let me check where it is. I guess I can just find it here. That's the easiest way. Okay, and then we see it here. So, what is priced in? I think 5.1% is already priced in. So the Fed is thinking, or I mean, let's calculate it. 11 people from the Fed committee thinks that we see 5.1%, and on the year 2024 we see 4.125%, which is interesting. So nothing special changed over there. Let's check what is the liquidity telling us, if we see some liquidity coming into the market. So we saw a big spike, and yeah, we don't see much. We still have this CME gap open, so maybe it's the time to go today to 26,750 to close this CME gap. But overall, it looks more negative. And what are my thoughts right now about this kind of scenario? Let me do that via Paint to that you can follow through my words. So what I am thinking is, so obviously I'm calling this one the interest rates. If we higher up the interest rates, right, then this will cause the inflation. Let me calling it IN should go lower, right? If we have high interest rates. If we have lower inflation, or want to fight lower inflation but doing it with high interest rates, this will cause as well unemployment rate. So let's call it UN rate is going higher. So, and this happens as well, that then the economy, let's call it EC, is going bad as well. This is caused by high interest rates. And as well, on the other hand, we have right now the bank problem, right? But I think the Fed, because you cannot, as you see, you cannot help both, right? So the bank problem, the banks go lower, So you cannot fight both, as you see here, right? You cannot fight inflation and bank problem on the same side. But what is the Fed doing is they can still fighting inflation because this is more important. I mean, what is more important? If every bank is falling down, right, then fuck the inflation, then we have a bigger problem. But the Fed can help the banks with the money injection. So giving them a money injection would help them. But again, this is not printing money, what everyone is thinking. We are not printing money. We are not, the Fed is not buying bonds, right? This is very, very important. And why do we see right now that the Bitcoin is pumping to the upside? It is because we see it that stable coins, right, let's call them like that, are sold, and with them they buy Bitcoin. And why is it like that? Why do people sell their stable coins to buy Bitcoin if we know that we have a little crisis and Bitcoin can go lower? Because these stable coins are all times related to the banks. So for example, if you hold one USDC, which is correlated that this bank has $1, right? Then you're taking the risk that the banks are falling down, so the dollar is away, and then USDC is falling down as well, and it is then not at $1 anymore, at 0.5, for example. So that's why people is buying with their stable coins some Bitcoins, right? I hope this makes sense as well for you guys, why we see people buying with stable coins Bitcoins, because you want to reduce your risk in BTC, right? This is very, very important to know. So let me check what else we have. Question, can you hear me well, guys? Can you do I have a little, because I see, I mean, it looks fine, I guess everything looks okay. Let me think if my press conference is here working. Yeah, everything works fine. So yeah, maybe as well we find maybe a trade today together here. But it looks a bit difficult to find a trade, because I see just on my trade I closed, I had big slippage on it. So for example, you see that here right now. Oh, now it got closed. Nice. Finally, I couldn't come out of my position. But as you see, if we checking this one, I had my first short trade here today in ETH. It was perfectly here. Let me change my color so you can see it as well. So my first entry today was here at this low, stop loss above that, and I took first partials here, first partials there, so it was fine. Normally I would be stopped out break even, but somehow he didn't took out my stop. So in my case I was lucky with that. Then as well I was trying to short, or I did it actually today. I shorted as well ADA today. ADA was nice as well. So if we checking ADA, I already have it on. So let me find it. Oh, it's the wrong window, I think. Yes. Okay. Here we go. So yeah, I have another short here. As you saw, I perfectly got the top. I took my partials here, and then I got stopped out break even. So easy peasy here as well. And now it could be nice if we maybe see if the news wouldn't be there, if we see a little drop down below this low here, market comes back and we find a short here, maybe we find something like that. But of course, it will be important what the Fed is doing and saying, what Jerome is saying, before I do any short trades. Let me check out. If you have some questions, feel free, of course, to ask them in the chats. I will check in the moment right now what the news are saying on Twitter. You know, it's never bad to check if something is happening there, if we find something there, but I think we can't see anything special. So what we can check is this one, and then we can see the summary. Here, that's exactly what I said before. The Fed projection. The Fed projection shows there will be one more 25 basis point hike this year and 75 basis point cut in 2024, which means we will have which means we have a big interest rate over the whole year, which is crazy. If they're really doing that, then we would have a big and long time staying with this high interest rates, which will be super negative. Okay, so that's the statement. Let's read what they said. Recent indicator points to modest growth in spending and productions. Jobs gains have been robust, picked up in recent months, and are running at a robust pace. The unemployment rate has remained low. Inflation has eased somewhat, but remains elevated. Okay, I think it was the text from the last time. No, it is the same. That just written super similar. To 5%. The committee anticipates that ongoing increases in targets will closely monitor incoming informations and assess the implications for monetary policy. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the extent of increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economy activity, inflation, and economy and financial developments. Okay. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming informations of the economic outlook. Of course, the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflations, pressures, inflation expectations, and financial and international developments. Okay, overall, I would say that is written as everyone would think of, so nothing really special. But yeah, I think that what we see right now, it was absolutely clear. I think every good investor knew that they're gonna rise 25 basis points because it would be too risky to not doing that. So Barnier was writing, it's about to pump. We will see, my friend. But of course, the chance is high. But I like to see the... Okay. Let me know if you can hear as well the sound of of the system, because obviously it would be bad if you can't hear that.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system.
Okay.
These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury,
But can you hear the
the
sound
Federal
as well
Reserve
from,
Board created the Bank Term
Jeremy?
Funding Program to ensure that
good
banks
boy.
that hold safe and liquid assets can, if needed, borrow reserves against those assets at par.
And somehow,
This
I don't know
program,
why, but
along
my
with our
platform is just
long-standing
buying,
discount
and I don't
window,
know why.
is effectively meeting the unusual
Somehow
funding
it's
needs
buying and
that
I
some
cannot
banks
close
have
my order.
faced,
Wow,
and makes clear that ample liquidity in the system is available.
come on. Can
Our
we
banking
close it?
system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
High inflation has problems.
Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months.
Yeah, he is just talking about
the unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year.
So this is
remains
very important. If we're checking that again, this is really important. So the change in real GDP, I think all is understandable on that, but this is important. So with the increase of sorry guys. Okay, now I get a sync. Oh, lol. Somehow, sorry, I just have to fix it because somehow my platform is just buying and selling, as you see, and I don't even know why. I'm just trying to shorting it, but it's not doing anything. I mean, it's fine. He's shorting the market, right? But fucking hell, I don't want to do. Naja, I mean, now I have good profit, but I cannot closing it. Jesus. Okay, sorry. This is what I have to fix first. Lol. Yeah, so I think this is the most important one what we have here, because if they really think that we're going to the unemployment rate of 5% this year, it would be crazy. And this is showing as well that the bottom is not in this year if we're going that high of unemployment rate, which is super negative, right? It's not positive at all for the market. If he's talking about that big of an unemployment rate, what he's expecting today. So I guess I just have to close my my trading view for a moment. It's just opening positions, and I don't know why.
4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation...
This would be absolutely beautiful if obviously we can get that, right? But the question is if we can get that. So if the inflation is going lower, how they are predicting that.
Back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions, meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions.
So, yeah, overall, what is
Restoring
he saying
price
is
stability
that,
is essential to set the stage for achieving
that he wants to
maximum
get,
employment and stable prices over the longer run.
They still think they could increase it.
To conclude,
but
we understand
they
that
have
our
their
actions
roadmap
affect communities, families, and
everything is
businesses
going
across the
like they
country.
predicted, so
Everything we do
that the
is in service
unemployment
to
rate
our
is
public
going
mission.
like that.
We
how
at the
they
Fed will do
saying
everything
it.
we can
The,
to achieve our maximum employment and price
how to
stability
say it,
goals.
The
Thank you. I look forward to your questions.
PCI inflation is going lower, the inflation is going lower, then they're going the same path. But if something is changing, then of
Colby
course
Smith
they're
with the
changing
Financial Times. How
aggressively
confident
as well.
is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe.
Okay, here is very important and a very good question about how is the banking system right now in America, because I think the biggest problem is if the Fed is talking about that the bank system is not safe, obviously then we would see a bank run, right? But here he said it again, they didn't print new monies, they used it from the treasuries to help the FDIC to insurance the clients. Very important, no printing money. So there's no quantitative easing.
Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes some policy firming may be appropriate. So going forward,
maybe you have to lose
as I
as well.
mentioned,
How
in
he
assessing
was
the need for
talking
further
was
hikes
like,
will be focused as
yeah,
always on
we
the
changed-
incoming data
we
and the evolving
changed,
outlook, and in particular
our
on our
policy
assessment of the
from
actual and expected effects of credit
going
tightening.
with more hikes to maybe we're going with a little bit more hikes.
Mr. Chairman, can you
But
explain
it was so funny to see
the difference
confusion
between
in his
ongoing
face.
rate increases and
firming?
firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular, our lending facilities, the discount window, and also the new facility.
Okay, this question was really good. He asked, is this a bigger problem with the hike what we see right now from the 25 basis points? Because we all know, and we've been talking about it as well, that he cannot beat both inflation and bank crisis. So the question was, with 25 basis points hike, do we can still expect a problem in the bank sector? And his answer was kind of not a solution for the game. It was kind of, now we still have to look at the credit, like if you want to take a credit, to tighten that. So there should be a bigger regulation on how you can get money, which means not from the consumer side, which means from the bank, what can take the bank from the Fed. So for example, let's give me an example. If you want to take money from the Fed, you need a margin, for example, 5%, and then you can take money. But if they want to tightening it, then it can jump from 5% to even higher, which tightening as well what's it called? The in the end, the tightening that as well for the consumer. So very important.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting, but I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effect.
Tightening credit conditions, as I said. So what they want to do is tightening how the bank can get credits from the Fed, and as well then obviously they will tightening as well for the end consumer. That as well. So yeah, same answer like before.
As our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people. It's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
Good question.
You know, we know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, you know, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
Good guess, maybe. I don't think so.
Hi, Victoria Guida with Politico. I wanted to
So maybe funny picture as well. Deutsche Bank CDS. So the CDS, which means the credit default swap, so the insurance of a default of the Deutsche Bank, and as you see, it went high as well to 500, and yeah, I'm not sure about that. And you saw the Credit Suisse was in the end was super high as well, but I'm not sure about that the banks are managing that. I'm not sure.
to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets.
Okay, the question here was, what was the reason that they give now the FDIC to ensure every client on any bank unlimited deposits? So if the bank goes bankrupt, then the money in there is safe. And his answer from now is that he's saying they just did it because they've been scared that if one bank is collapsing, then maybe other banks are collapsing as well. Again, I still don't think so, because the Fed, every central bank on the world, has one thing to do. This is managing the money outflow around, and as well giving the trust to the people that they have everything under control. And I think as well that's why they did that. Imagine nobody would get his money out, then obviously the everyone would go to the bank and take out the money, right? So we would see a bank run, and this would cause economic problem. And I think maybe as well that if a bank collapses, a big bank like Credit Suisse or something, it would collapse something in the economy as well. But I think the main problem was the bank run of the people on the consumer side.
More broadly, that was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index where you've got a story that's ongoing. Where we didn't have in February and we still don't have now is a sign of progress in the non-housing services sector. And that is, that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet. And that's of course, 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and it's very...
Yeah, that's a good thing as well. But here, and I think as well, this is negative for the market. What he's saying is, if he's doing the creditative tightening in the market, they still don't know how this will impact the market overall and the banks, because if they're tightening the credits, taking credits, they don't know if this will solve the problem, because overall the problem what we have with the bank is of course a big problem for the economy. And now he's talking, but like kind of doing it, I don't know how to say it, but he wants to make it small, the problem small, and he's more likely on the call with the interest rates and then on the bank crisis. So he gave a little sign of that the bank crisis is not a big problem, but I think it's a bigger problem than what we have with the inflation. And that what he wants to see is that he sees in the goods, so on milk, the products we use daily, we all seeing already a decrease of inflation in the latest 6 months. We saw them already. And in the housing market, we see a little decrease in inflation as well. But this is only 44% of the PCE data, 56% of the PCE data are the not housing market, how to say it, not jobs, but Dienstleistungen. Forget, I don't know the English word, but like everything which is not related to houses are 56%, and they are still strong, and they want to keep it low, but they can only manage it to keep it low if the demand is going to decrease, or if the unemployment rate is going lower. And we see that as well in the price already, that when I said it's negative, S&P 500 was just going since then lower as well. I think we are in a good buy zone for the dollar index. It's a pretty nice zone. Cryptos was not strong this as well. So yeah, we see a little move to the downside as well. Yeah, services. Thanks. Yeah. Sometimes
very kind of rule of thumb,
sometimes you cannot
guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits
Let's see
and
if
in
we
terms
find
of
maybe
its
another bank which
holdings
goes
of
bankrupt.
duration risk.
And
again,
then maybe it
supervisors
was
did
not
get
just
in
a
there, and
mistake
they
of
were,
the
as
Silicon
you
Valley
know,
Bank.
obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain.
That's a good point, right? So I mean, I don't need to paint that, but obviously, if they're tightening credit conditions, then the demand to buy some services are going lower as well, because people cannot take easy credits to pay the services, and that's why inflation can go down as well. Just a question, what will bring the inflation down? Is it maybe high interest rates, or is it a combination of both? Because he just said in his view that he will tightening as well the credit standard, which could cause more problems, right? High interest rates, tightening credit standards gives every time big problems in the market.
How long the situation will be sustained or how significant any of those effects would be, so we're just going to have to watch. In the meantime,
but yeah, market since then, since he was talking and making it small, the problem of the banks, the market is moving lower and lower, as you see that here as well. It was a really bad sign for the market, because I think to tightening credit standards and having high inflation, it's not a good sign for the market. So we're seeing again more.
And obviously, at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next. and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really.
Well. And again, as you see that here, he's using every time the same words and every time saying the same, like, it's well capitalized. And how can he say it if he has to bail out the clients because the bank don't have the money to do all the withdrawals? It's super negative, and he's just saying the same, which sounds a little bit confusing actually, and not positive at all for the market.
We don't see that as at all analogous to this.
And one other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to
availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect.
Yeah, I think we don't need to hear much. I think that was our point. He just said it again. The money that they give, it's completely different, and obviously it is, if you're checking them. It's different what they normally do in quantitative easing, because in quantitative easing they will buy some bonds and increasing their balance sheet. They don't do that here. Again, that's why, and he said it again, it was not a quantitative easing move, and they are not going to think to push more money into the markets. We will see. I think they will. If a bank is going to bankrupt, they will help the bank again. But yeah, as you see on it again, market is moving lower and lower. So what do I think about the market? Let's do that real quick. News not that positive. We will see what the market will do on tomorrow, because today it could be just it could change in the middle of a time, just when he's changed his mind or changing his words, but I don't think so. S&P 500 is moving lower and lower as well. Daily candle looks promising right now for the next days for going even lower. And as well, ADA, BNB, ETH looking like that they can't going through their levels. We topped out at the high. Unfortunately, we didn't close the CME gap on BTC, what I wanted to see, because we still have a gap over here. And if I'm seeing it directly, the gap is here. No, I wanted to see it here. The gap do we have is, oh, actually we directly we closed it today. Nice. Nice. So yeah, that's from my part. I hope you liked it, and have a great day, and arrivederci. I will make as well a video on this channel today, and then I again round everything up. So have a great day, and thanks for having or for being